This program is titled Property Casualty Loss Reserves, and it features the insight and expertise of Brittany Henrich, Associate Actuary, and Patrick Newell, Consulting Actuary, both of Pinnacle Actuarial Resources. Originally delivered to a live audience of both on-site and webinar participants, the session originated from the campus of Illinois State University. It's a collaborative effort of the Institute's Griffith Foundation, IRF, and the Cady School of Insurance at Illinois State. In keeping with the respective missions of these organizations, this program is purely instructional in nature and does not support a position on any issues.
We will be reviewing some property and casualty loss reserves today. And just to get started, this first slide is just an agenda of what we'll be covering today. And to start off, I will be discussing some current considerations within the loss reserving industry. Next, I'll kind of go into the role of actuaries and SAOs, along with the COVID-19 effects on our analyses. Finally, Patrick will be finishing up with some P&C loss reserving definitions and go over some examples for you guys. So to kick things off, what is the underwriting cycle and is it turning? Well, as you might know, the soft underwriting cycle is a period of time in the insurance industry where insurers tend to be more flexible with their writing. And this is characterized by higher limits.
We've got two, and just try to mute it. I think that we have two. Yeah, the one in the background.
Thanks for joining us today. As mentioned, we will be reviewing some property and casualty loss reserves today. And just to get started, this first slide is just an agenda of what we'll be covering today. And to start off, I will be discussing some current considerations within the loss reserving industry. Next, I'll kind of go into the role of actuaries and SAOs, along with the COVID-19 effects on our analyses. Finally, Patrick will be finishing up with some P&C loss reserving definitions and go over some examples for you guys. So to kick things off, what is the underwriting cycle and is it turning? Well, as you might know, the soft underwriting cycle is a period of time in the insurance industry where insurers tend to be more flexible with their writing. And this is characterized by higher limits and more coverage options being available to customers. And these options are even offered at lower premiums than they would be in a hard cycle because insurers are trying to grow their market share and grow their customer base. But then on the flip side, we have the hard market cycle where there's more stringent underwriting, tighter limits, tighter coverages, and higher premiums. And during this time, insurers tend to focus on quality of business and their customers rather than growing that market share. So the next few slides that I'm going to show you are going to be graphs similar to this one. They will be for various lines of business, but the main point is some people may question whether the underwriting cycle actually exists or not. But as you can kind of see here, there are clear shifts in profits for the insurance industry by year, with some of these shifts being a little more significant than others. Obviously, in 1998, the bump upwards is a lot higher than it is in about 2005. But in general, though, when the industry does see those larger loss ratios, such as in 1998, then the hard market conditions that we talked about start to kick in. And what this means is that the premiums start to increase, the coverage starts to shrink, and that way the insurers are able to get back to profitable levels, and you do see that decrease in the loss ratios. Similarly, for a soft market, this occurs when the businesses are profitable at the moment. So that would be at that lower divot there in 2005, where the insurers are trying to gain market share by lowering their premiums. which ultimately leads to the worst loss ratio trends, and we see that the loss ratios go up again. So this next slide, sort of similar to the first one, it is showing you the California loss ratios versus the countrywide loss ratios. So for workers' compensation, the countrywide loss ratio is that blue line that you see on the graph, and that is the exact same graph that you just saw on the previous slide, but this time we're overlaying California here. And as you can see, California does mirror the countrywide ratios. It has the same ups and downs at about the same times, but it's definitely more pronounced than the countrywide ratios. And this just shows how California is a huge contributor to the overall countrywide loss ratios. And another point in this graph that I like to point out is that it also illustrates that there are differences between the states, between the loss ratios and all of the assumptions that go with it. And this is just important because, as we all know, insurance is regulated at the state level. And for this graph, just taking a quick look at general liability, you can see that the trends are kind of the same as work comp. We have that big upward loss ratio in 1998, followed by a decrease and some smaller bumps along the way, but it's a little more muted than the work comp ratio, but you can still see the same trends. And finally, for commercial auto liability, again, you can see a similar trend here to the workers' compensation underwriting cycle. But for this graph, I just like to point out that in recent years, you can see that a loss ratio of greater than 70% has been seen since 2011. And you may or may not know this, but that has caused some concerns in the industry for the past few years. It's a fairly high loss ratio when you consider that you have to still pay for expenses and make profits on top of that. And so this has just resulted in some increasing rates more recently and some heavy discussion within the industry on what to do with commercial auto in particular. So what do all these underwriting cycle graphs mean? Is the industry in trouble, or has it ever been? Well, not necessarily. As we can see from this next graph, the industry surplus has been steadily growing over the past 20 years, from about 300 billion all the way up to over 900 billion in 2020. So in summary, for this section, there is an effect on the market on reserves. For a soft market, we see the premiums are reduced and thus loss ratios increase, and vice versa during a hard market. And it's just important to note that there is a lag of a few years between these reversals. It takes the insurers a while to recognize what state we're at in the market, and then for the premium changes to take effect and for you to see those switches in loss ratios. And then aside from those differences, we also see that there are profit differences and a difference in quality of business underwritten and market share levels between the two cycles. So now that we have an idea of the current market conditions, we can kind of move on to the role of actuaries and SAOs and why we're here today. So to start with, there are two professional organizations that most credentialed P&C actuaries are members of. There is the Casualty Actuarial Society and the American Academy of Actuaries. Both of these organizations have their own roles and their own sets of standards, but they do provide continuing education. There is a board for counseling and discipline for actuaries, and there's standards of practice for all of us to follow and kind of go by when we're doing our analyses. So just a little history lesson about actuaries and auditors as well. Regarding those standards that we just looked at, we're going to dive into 2004 to get started. And there were some new responsibilities for both the auditors and the actuaries regarding the review of insurers. For auditors, these consisted of identifying relevant data, understanding company controls, and conducting a variety of tests. Actuaries, on the other hand, had a long list of new requirements, mostly revolving around data and communications that we're going to get into a little more detail on. So one of these new responsibilities was calculating IRIS ratios 11 through 13, and then also discussing the results within our reports. So IRIS ratio 11 is known as the 1-year development to surplus ratio. 12 is the 2-year development to surplus ratio, and 13 is that last one there, estimated reserve deficiency to surplus. And what we have to do is calculate these values and then discuss the critical values for these ratios. And if we do see odd results where the ratios are above a set percentage, then we have to elaborate on the reasons for the odd results and give a little bit of discussion and background on that. Generic responses, such as reserve strengthening, is viewed as a weak reason, and so these new requirements do call for more disclosures and more details now in the reports. And lastly, for 2004, if there is a presentation of results to the board, then the actuary would convey important risks and uncertainties that are outlined in the report, and specifically note the risk of material adverse deviation, or RMAD for short. And we have to discuss whether or not we believe those risks exist. And then the minutes of this board meeting just need to be noted by the board somewhere. Moving on to 2005, we now have to file an actuarial opinion summary as well. And that is AOS for short. As you can tell, we like our acronyms here, and I know Patrick has some more for you to learn later. But this needs to be filed by March 15th. It is not a public document, but it is basically just a one-page summary of the important results of our analyses. And what it consists of is a table of the actuary's range of reserves, the company's held reserves, and then the differences between the two. So the actuary then compares the 1-year adverse development to prior year surplus for 5 years. And if we see a persistent adverse development, which is just characterized as 3 of those 5 years being greater than 5%, then again, we have to comment and disclose on why in detail and discuss maybe the insurer's thoughts and plans and some conversations we may have had with them about the reason for these adverse development years. Also new in 2005, a change in appointed actuaries now follows a similar procedure to a change in auditors. Both the company and the actuary have to separately file letters that discuss reasons for the change and any differences in opinions or assumptions between the two parties. And ultimately what this new requirement does is to prevent actuary shopping. So previously, maybe a company got a number they didn't like or didn't agree with the actuary on, and they could just switch actuaries until they found a number that they did like. But now there's more procedure, more documentation is required, and notification to a commissioner within 5 days is needed. So to wrap up our history lesson, another big change in our reserve reporting was for Exhibits A and B of the SAO. Going back to 2004 again, both of these exhibits were brand new to the SAO, and they were just designed as a way to show the key numbers of the SAO in a single location. Exhibit A shows reserve amounts that the actuary is specifically opining on, while Exhibit B showed key items that may not have been opined upon necessarily, but are still significant to the analysis, such as asbestos reserves, whether anticipated salvage and subrogation was considered, and that kind of thing. And then in 2007, there was a change to these exhibits where they're now submitted electronically, which did open up a great way to collect data and information for both external and internal data studies for companies. But the biggest change was just that Exhibit B had a bunch of non-numerical points added to it. Some examples are the actuary's name, a definitive statement as to whether or not the RMET exists, and then a type of opinion that was issued needs to be checkmarked, whether that be reasonable, excessive, or whatever the case may be. And now for everybody's favorite topic of today's day and age, we're going to move on to the effects of COVID-19 on reserve reporting. So in 2020, the American Academy of Actuaries, which is one of those governing boards I mentioned earlier, published a practice note regarding COVID-19 guidance and our considerations as actuaries. It was updated in 2021, but just some clarifications rather than big changes. So some considerations that they pointed out to us are, plain and simple, if COVID-19's impact on reserves is significant or not for the company you're reviewing. Some other items are if any premium refunds were issued, what kind of work comp benefits may be covered under this loss, and then some non-coverage changes are also some changes to data that we must consider, and these include our loss development patterns, which Patrick will dig into a little bit when he goes over his examples, and how those might change due to delays in the court system and just reporting in general. For people to report claims, it might take longer now. And then also we need to consider changes in our assumptions to exposure data, which might not be accurate anymore, given that nobody really saw what was coming in 2020. So in response to these new considerations, I'm just going to run through a few real examples of COVID language that was found by some coworkers in recently submitted SAOs. And I won't read them all to you. These slides should be available for you guys to look at in depth if you would like to. But from these 4 quotes, the 2 main ones that I wanted to point out were that some risk factors commented on by actuaries are the reduced driving that we saw due to COVID, and then the changes in the virtual systems, tools, and protocols that may have occurred. So for the reduced driving, obviously people weren't going to work, they were staying home, which means there's less auto accidents, less frequency of losses there. And then the change in virtual systems, again, people working from home meant that insurers may have had delays in their system or had issues with the current software on the computers, where in the office it worked great, but at home they may have to use something different. And so this just contributed to more delays and lags in claim reporting, claim settlement, claim data, that kind of thing. And just another page of risk factors to consider. Again, the 2 that I want to point out on this one are the delays in data, which I kind of discussed with the court cases, and the change in systems that not only affects how long it takes to settle claims, but also can affect their severity. And with all the new inflation that we have seen, this also compounds that effect. And then there's also a potential for increased medical costs that occurred due to delays in non-emergency surgery, as people were putting off their surgeries for illnesses that may not have been so bad at first, but as we wait longer and longer to get them treated, they may have grown in severity, and more complications may have occurred, increasing those costs. The next slide is just a few examples of relevant comments that were made instead of the risk factors. And these 2 examples basically just disclose that the COVID impacts were considered by the actuary within their analysis. They weren't just disregarded. There is differences that we did look into. Finally, the last COVID thing I'm going to talk about is just the changes in methodology. And such changes include updates to the loss development patterns I mentioned on the first slide. And then also changes in salvage and subrogation may be different. And the current discussion is related to methodology is kind of what the industry is actually going to do with this 2020 data in years to come. Should we be using it in the future, or should we set it aside and label it as unreliable as we emerge from this pandemic and its effects? I know that depending on the line of business, depending on the client, there have been differences within that 2020 data, and you can see a clear shift between 2019 and 2020. So we just need to keep an eye on that and watch as it develops and see what to do in the future. And here's just some language examples, again, from real SAOs to wrap it up. The one that I'm going to specifically refer to and point out on this slide is the last one and the long one over there. But to sum up, it basically discusses that change in loss frequency that I mentioned for auto insurance. This company in particular saw a frequency decrease of about 22% on an annual basis. But interestingly, what they pointed out here is that when the trends were compared on a monthly basis, that frequency range decrease was from 20 to 50%, depending on the month you were looking at. And this variation in assumptions on a monthly basis versus a yearly basis is something that we consider and something that we must be aware of and think about. It's nothing new to actuaries. We've been taking exams that have prepared us for this in the past. It's really similar to businesses that have a seasonal kind of effect going on. So, for example, I know the exams I've taken, it has talked about ski resorts and how your general liability is going to be a lot higher in December, January, February, when you have all of your customers coming in and skiing and all those injuries and liability issues, compared to in June and July when all you are is an open ski town with a few shops. So again, it's just something we know how to deal with. We just got to keep an eye on. And now I'm going to pass it off to Patrick to discuss P&C reserving and some examples.
Awesome. Thank you, Brittany. And so we just heard Brittany do an excellent walkthrough of the macroeconomic environment as it relates to loss reserving. And in my section, we're going to dive a bit deeper into the process an actuary actually goes through when conducting a loss reserve analysis. But first, Brittany had her history lesson. And so not to be outdone, I'm gonna hit you all with a vocab test. So we're going to learn some key terms that we all need to understand before employing some of these actuarial methods for estimating ultimate loss. And then we're going to put those into some practical examples by walking two claims through their life cycle. And then finally, after we walk through those two claims and their life cycles, specifically highlighting how claims can develop significantly differently from one another, we're going to get to our methods for estimating ultimate loss. And I can personally attest, having worked at some of the largest insurance companies in the country, that the four methods that we're going to walk through are used by not only some of the largest insurance companies in the country, but they're also used by some of the smallest. And so basically just wanted to say that this is not just a theoretical exercise. These are practically used in the industry and pretty much used ubiquitously across insurance companies of multiple sizes and offering different coverages. So without further ado, first we get into our definition section. And the first one, losses, there might seem relatively simple. However, that term can be used differently across various insurance companies. The one area where it seems to be pretty much consistent is that when somebody refers to losses in a reserve analysis, they're talking about the dollars. And when they refer to the term claims, they're talking about the number of claims that occur over a specific period of time. Where it can be a bit more ambiguous is whether or not the losses include DCC, or defense and cost containment. Very often the analysis should explicitly say that the losses either include or exclude defense and cost containment. So your defense and cost containment expense were formerly known as allocated loss adjustment expense, because they're really expenses that you can assign to a specific claim count. The reason why they've been renamed to defense and cost containment is because the large portion of these expenses are related to the legal defense or of the insurance company is required to provide in the event that one of their insureds is sued. That is the largest portion of that expense. Whereas your adjusting and other expenses, basically your all other expenses associated with handling a claim. So one example for your adjusting and other is the salaries of your claim adjusters. Because claim adjusters are typically handling so many claims at once, it's very hard to assign their salary to a specific claim count, for example. And adjusting and other was formerly known as unallocated loss adjustment expense, based on it not being able to be allocated to a specific claim count. So then we have our case reserves there in the bottom left-hand corner. Those case reserves are assignments to a specific claim count for what a claim adjuster expects a particular claim to ultimately settle at when it's all done and paid for. For example, if an insured takes pictures with their phone and sends the adjuster these photos of an auto accident, for example, the adjuster will review this, make an assessment to what that claim will ultimately settle for based on their experience and those photos. But then there's an extra portion assigned or that is a component of loss, and that is your incurred but not reported portion, your IBNR. And that is basically an assessment that the actuaries make, and the reason why actuaries are involved in loss reserving by and large. It's basically the understanding that once you aggregate all these claims together, even though we are reviewing claims on an individual basis and setting case reserves on those claims, we have an understanding that those claims in their aggregate aren't necessarily going to settle ultimately for what that case reserve estimate is. We know that, for example, a loss or an adjuster could be wrong, right? And I'm going to go ahead and advance to the next slide because we actually dive deeper into the components of IBNR. And the one I'm just starting to talk about is the upper left-hand corner, which is your development on known claims. So the insurance company is aware of the claim. We've, in a lot of cases, established a case reserve for that claim. However, it's very rare that case reserve is going to be exactly right. It could go both ways. That case reserve could end up settling for significantly higher, or that claim could end up settling for significantly higher than what the case reserve was, or it could actually settle lower. And so one portion of the IBNR that the actuary calculates is to basically acknowledge that this is a possibility. Another portion of IBNR is your incurred but not yet reported, or your pure IBNR. And that is for claims that have occurred but have not been reported to the insurer yet. So an example of this might be your homeowner's insurance. So say, for example, there is a big wind event and it blows off lots of shingles, or at least some of the shingles on your roof. And I don't know about you, but I don't necessarily put my ladder up against my house and go and do a review of my roof after something like that happens. And so sometimes the insured won't know that they've had a loss until maybe the next big rainstorm comes through and the water starts coming through holes in their roof, for example, and there's water inside the house. So that would be an example of a lag in the reporting, right? And so actuaries often will set a provision via the IBNR for such an event. The next two are typically smaller components of IBNR. However, depending upon the insurance company's operations and their how they basically settle claims, they can be significant. So the first one is your pipeline claims. That is for claims that have been reported and the insurance company is aware of them, just due to the nature and the complexity of how the insurance company operates. That particular claim and its associated data hasn't made its way into the loss reserving data that is used for establishing IBNR as of the particular valuation date. The last is your reopen claims. So this is a provision of IBNR that's established for understanding that there's a propensity for claims that are supposedly settled at a particular point in time or are settled at a particular point in time, but for one reason or another, reopen and have additional payments on them. A lot of times these are associated with kind of claims that have some legal aspects to them, where kind of lawyers kind of sink their teeth into them a little bit. For example, like your liability type coverages. If there's a slip and fall, and there could be payments for several years down the road, sometimes those will settle, and then the insured will go and seek legal advice, and all of a sudden they'll reopen and have more payments made. And so again, hopefully some of this is captured as of the valuation date in the actuary's IBNR estimate. Finally, this is the last slide of terms, I promise, but it is necessary to understand these terms before getting into the methods for estimating ultimate loss. These are data aggregation terms. And so your upper left-hand corner, we have an accident year, and that is a data aggregation method that basically takes all losses that occur in a specific year and aggregates them together. I'll give you an example. If a loss occurs in 2020, but isn't reported until 2021, if you were doing an accident year analysis, that particular claim would be aggregated to accident year 2020. However, if you were doing a report year analysis, the next box to the right there, that loss or that claim would be aggregated to report year 2021. Report year analyses are usually used for kind of what I was alluding to before, your longer tailed, or sorry, your type of coverages or line of businesses that have a much longer lag associated with the reporting. For example, your medical professional liability, where an occurrence could happen and then maybe not actually, the doctor, for example, might not actually be sued for several years down the road once a lawyer figures out that there's a case, for example. Calendar year is more of a financial term, and it's really just like an insurance company, just like any other company in the country, needs to be able to report their earnings on a fiscal basis or on a fiscal year basis. And so that's essentially calendar year is taking those accident year and report year analyses and then basically manipulating them so that they can be added to an income statement on a calendar year basis. We're going to dive deeper into examples of how to do that in the next couple of slides, so I'm not going to spend too much time there. Your age of valuation and your valuation date, they go hand in hand. So going back to our accident year aggregation example, if you have a loss that occurs in 2020 and you evaluate your accident year 2020 losses as of 12/31/2020, your valuation date at that point would be 12/31/2020, and we would call the age of valuation for accident year 2020 in that case 12 months or 12 months mature. Whereas if we looked at our accident year 2020 as of 12/31/21, obviously our valuation date in that case would be 12/31/21, and our age of valuation in that case would be 24 months mature. And again, we're going to go through examples of this here in the near future. So before we get into the estimates, we're gonna walk through two life cycles of two claims that on the surface of things appear to be very similar. But once you dive deeper, you realize that they're going to be significantly different by the time they settle. And so claim A here, you see it's a liability type coverage. It's a slip and fall incident that occurs in December of 2020. The insured actually doesn't file the claim until January 13th, 2021. So right away in your mind, you should think to yourself, well, okay, that means it's accident year 2020, but report year 2021, right? The adjuster kind of sees the information. It seems like they've had experience with this type of events, and they establish a case reserve of $10,000 for the loss. It looks like, they have some back and forth. They end up settling not too long thereafter in September 1st, 2021, for something less than the case reserve. So it actually developed favorably relative to what the adjuster had established. And so it ends up settling for $6,500 versus the $10,000 that was established by the adjuster. Now on to claim B. Very, very similar claim here. However, there's one small difference that probably wasn't provided, or this piece of information probably wasn't provided to the the adjuster, because we see it's the same event. It's a slip and fall in December 2020. Medical treatment sought around the same time. It's reported to the insurance company in January. However, before they did that, they sought legal advice, which would be probably key to an adjuster kind of in informing them that, hey, this has the potential of being significantly more severe than the prior claim. And indeed, having the information that they did, they established the same case reserve, a $10,000 case reserve. However, come to find out, as of kind of the end of 2021, there's some disability involved with the person who slipped and fall, and there's some spinal damage as well. So it right away keying to the insurance company that this is going to be significantly more expensive than the first claim. And so they increased that $10,000 case reserve to $250,000 before the end of 2021. However, it's not the end of it, right? In this case, because these types of injuries can have a very latent and long payments pattern to them, an ultimate settlement was not reached until 5 years later, after some significant kind of legal battles and things I think were had, it seems like, where the insured was indemnified for $850,000, and the insurance company was also responsible for $150,000 in legal bills. So ultimately, the insurance company ended up paying out $1 million for something they had established an initial case reserve of $10,000 on. And so really, like, the two key takeaways here, right? The first point I'll make is that actuaries are a bunch of worrywarts. We like to talk about the things that can happen. And sometimes those discussions are hardest to have with an insurance company that maybe hasn't had a loss like that in their future or in their history. And so, yeah, just kind of pointing out the possible, right, and why IBNR exists, right? And then point B is claims like Claim B have a leveraged effect on your income statement, right? And I mean, it's obvious to say in some regards, right, that a $750,000 claim would have a significant impact. But let's take, for example, the case where an insurance company that normally sees, say, 100 claim A's for every one claim B. Well, that goodness that we saw by reduction of case reserves from claim A was more than offset by the one case reserve from claim B, right? Thereby, again, kind of trying to justify, right, the IBNR position that actuaries kind of often take, especially at early maturities in an accident year analysis. Getting into the development now a little bit deeper, and this is sort of a core concept for several of the methods we're going to talk about later. What you're looking at now is a bar chart that walks an accident year across its different maturity stages, right? So let's say for illustrative purposes, this is accident year 2017. Well, that first bar on the leftmost column there, that would be your review of accident year 2017 as of 12/31/17, or 12 months developed there. And at 12 months developed, we see that accident year 2017 actually paid about 30% of its ultimate loss, and there was about 70% of ultimate loss that was reported by that point. So in other words, to have established your ultimate loss as of 12 months, you needed to add on an extra 30% of losses that we would define as being your IBNR, right? And then when we review accident year 2017 as of 24 months developed, or as of 12/31/2018, we see that about 65% of this ultimate was paid and 85% of it was reported. And then by the time you get to 12/31/21, or 60 months mature, about 95% of this accident year was paid and 98% was reported. And so kind of the key takeaway here is that actuaries use this historical payment pattern and reported pattern, that they look at these historical accident years over time, and they make the assessment of if there's some consistency between these accident years that we can then apply these patterns to future development. And so, again, that's kind of a key concept kind of coming up later in the presentation. But before we get there, did want to walk through another example of how an accident year kind of impacts an income statement over time. And so this case is we are looking at accident year 2018, right? And for accident year 2018, all losses that are reported in calendar year 2018 hit the income statement or are a reduction to the company's revenues in the income statement for 2018, right? So all, for example, in this case, we have a $1,000 of estimated ultimate loss for accident year 2018 as of 12/31/18, and all 1,000 of that offsets your revenue in the income statement for calendar year 2018. And then looking at accident year 2018 as of 12/31/19, or 24 months mature, it looks like the actuary recognized some adverse development and increased their estimated ultimate from 1,000 to 1,200. And because we've already recognized $1,000 of that in our income statement in 2018, we only recognize the difference in our estimated ultimate in our income statement for 2019. And that difference is that $200, the 1,200 minus the 1,000 there. Going forward in calendar year 2020, it looks like our accident year 2018 estimate, and we saw some favorable development. So we decreased our estimated ultimate from 1,200 to 1,100, and that $100 of goodness is then recognized in your calendar year 2020 income statement. And then finally in 2021, it looks like there was some adverse development from 1,100 to 1,500, and so that difference of $400 is recognized in your 2021 income statement. So then a couple of equations just to kind of hammer that math home. These two equations are equivalent. And really the one on the left says that in order to calculate your calendar year losses, you basically just take everything that the insurance company pays out in that particular calendar year. And then you simply just take the reserves at the beginning of the year and the reserves at the end of the year and subtract the reserves at the beginning of the year. So basically get that year over year change in your total reserves and add it to your paid loss to get your calendar year total losses. Whereas the equation on the right is more like the example we were just doing in the bar chart in the slide before, where we were saying, okay, for our subject year, so like in 2018 on the last slide, all losses from accident year 2018 are reported in our calendar year losses. But then for all of the accident years prior to accident year 2018, so your accident year 17, accident year 2016, just the changes in their ultimate estimates are then added to your accident year 2018 losses to get your calendar year losses for 2018. So as promised, I know it was a little Games of Thronesy for those of you who are Games of Thrones fans, where I was promising we'd get to the methods, and finally they came. But we're here now. And so these are the 4 methods we are going to discuss. What I will say is that, again, these 4 methods are utilized by some of the largest insurance companies in the country, as well as some of the smallest. I will say they're not the only 4 methods for estimating ultimate loss. However, I would venture to guess that it would be very rare that you run into a reserve or an ultimate loss estimate or reserve analyses where at least one of these methods were not utilized. The first method we're going to talk about is the expected loss ratio method. And this method, the underlying assumption is that the projected IBNR, the projected ultimate loss is best estimated via an a priori estimate in your expected loss ratio. And this method is typically utilized when an actuary does not have historical data to kind of work from, or for one reason or another, the historical data is deemed to be not representative of what the actuary considers the future development to be. I know Brittany talked through a lot of those examples of why your historical data, when she was going through her COVID-19 examples, might be kind of skewed for kind of using in a future loss development pattern. But some more examples of this could be that For example, the insurance company acquired a large portfolio, and therefore their historical exposures are no longer representative of their future exposure and future development, right? So if you take on a large portion of much riskier business, your loss development patterns are probably going to look significantly different than what they historically were, right? Another example could be just some large geographic change to a homeowner's line of business, for example, where, again, your underlying exposure, your underlying risk just isn't the same going forward to what it historically was. And then once essentially you've established that you have to make this expected loss ratio selection, it gets pretty difficult to establish this estimate in column 3. A lot of times an actuary will utilize sort of the similar kind of lines of business within the insurance company's operations to maybe look at to get an idea of what this loss ratio can be. They'll definitely utilize their understanding of the underlying risk to help inform them on what that loss ratio could potentially be. If there is nothing that is within the insurance company's walls that you could perhaps use as a proxy for this loss ratio, the actuary will very commonly use a benchmark for this. So publicly available insurance data for a similar line of business, for example, maybe from another insurance company that's similar to this one for this loss ratio. But once this loss ratio is selected there in column 3, the calculation of these estimated ultimates is very simple. Because your expected loss ratio is simply your ultimate loss divided by your earned premium, you take the earned premium that's provided by the insurance company and you multiply it by your expected loss ratio to get an estimated ultimate loss there in column 4. Then you simply just subtract your incurred loss to get an indicated IBNR there in column 6. The next method we're going to talk about is the incurred development method, and this was the method I was referencing when we had that components of IBNR bar chart a few slides ago, where we looked at the accident year 2017 and how it developed over time. Well, first we kind of have to develop that pattern, because really the underlying estimate or the underlying assumption of this method is that historical loss development is a good representation of what future loss development will be. So we need to establish what that pattern is. And the way the actuaries do that is usually by building what's called a loss triangle. And that's what you see here in front of you on this sheet. So in this case, we're looking at incurred losses. So your paid plus your case reserves. And we're stacking the accident years there in the leftmost column and looking at how those accident years develop at various maturity levels. So for example, that 796 is your accident year 2017 incurred loss as of 12/31/17. Then we review that accident year 2017 case incurred loss again as of 12/31/18, and it increased to 1,284. So on and so forth. We do that for each accident year and build the triangle that you see in front of you. Then we take that triangle and we actually have to calculate something called loss development factors, or LDFs. And effectively what these are doing is they are informing us of what the percentage change between each of these development periods are for each of these accident years at each point in time here. So for example, your 1.614 in the upper left-hand corner was that 1,284 of case incurred loss for accident year 2017 as of 12/31/18 divided by that 796 of case incurred loss for accident year 2017 as of 12/31/17. And so basically what we say is that our accident year incurred loss for accident year 2017 incurred loss increased by 61.4% between 12 and 24 months mature. And we do that for each of these age-to-age factors. Then we do a couple diagnostics of these. What we're showing here on this slide is a straight average of those factors down there. That 1.709 is a straight average of the 12 to 24 month development factors for each accident year shown there. Then there's a weighted average as well, where we simply just weight the same factors there with the losses shown from the previous slide. Actuaries will quite often use several other diagnostics here. For example, if there were some anomalies in these factors that the actuary wanted to exclude, they would do that. If there were some kind of changes over time in the insurer's operations or the underlying kind of risk there that caused the actuary to think that maybe more recent loss development factors are more representative of future development, they might select closer to the more recent factors. But ultimately, you have to make a selection, which is what's done there in row 3 underneath those averages. And then once you've made a selection for each of those age-to-age development factors there, you basically multiply them together in order to get what we refer to as an age-to-ultimate or a cumulative loss development factor. And the reason you do this is because this loss reserve analysis is being conducted as of 12/31/2021, and all the case incurred losses for each of these accident years that are represented are as of 12/31/2021. And so we know that each of these accident years have a different amount of maturity associated with them, and therefore we need a different cumulative LDF or loss development factor to get the case incurred loss to its estimated ultimate. And so that's exactly the math that we're doing here on this slide. We're taking that incurred loss in column 2 as of 12/31/2021, applying the cumulative loss development factor that we just calculated in the previous slide to take that incurred loss to its estimated ultimate as of 12/31/2021 under the incurred loss development method. You'll see that the older an accident year is, the smaller its loss development factor is, its cumulative loss development factor is. And again, that should inherently make sense because that accident year is more mature and therefore needs less development to get it to its estimated ultimate. Accident year 2017, you see a 1.0 for its cumulative loss development factor. And that's basically saying, okay, we believe that the losses as reported to date, that's case paid plus case, they are basically accounting for all or your entire ultimate loss. In other words, you don't need any IBNR on top of your incurred loss of 1,547. It's already at its ultimate loss and it's fully mature. I'm going to skip through this example for the sake of time here. This is the incurred loss development method just with our medical professional liability. And this is really just highlighting that not every line of business is equal under this method. In some cases, it takes significantly longer for these accident years to develop to their ultimate. In this case, this medical professional liability, it looks like we're not considering these accident years to be at their ultimate until they're 120 months developed, whereas with our general liability example that we were just on, it only took about 60 months. So next, we're going to talk about the paid loss development method. And the underlying assumption with the paid loss development method is exactly the same as the incurred loss development method. And it's that historical paid losses and how the accident year develops over time is a good representation of how we feel future loss development will be. However, we exclude our case losses in this method, our case reserves, that is, in this method. And the reason an actuary might do this is number one, that first of all, just case reserves just aren't available. Maybe the insurance company does not do case reserving. Second of all, it could be, again, that the historical case reserves are not well representative of an insurance company's future operations. If the insurance company, for example, instills some new directive where they want to close claims at various sizes at different speeds than they historically had been, that's going to distort your incurred triangle to the extent that your incurred development method factors are not going to well represent future loss development. And therefore, maybe using the paid loss development method would be a better choice. I'm not going to walk through the calculations here because it's the exact same. We build the loss triangles, we calculate your loss development factors, we select our cumulative loss development factors using the paid data, And then we basically apply those cumulative LDS to our paid losses as of 12/31/2021 to get an ultimate loss estimate. One thing I'll point out is you'll notice here that the cumulative LDS are larger than they were for the incurred development method. And that should inherently make sense as well. Once you've layered on a case reserve on top of your paid losses, you would, in essence, be closer to your estimated ultimate and therefore need less of a development factor applied to that number to get it to its estimated ultimate. You'll notice here again that accident year 2017 has a cumulative LDF of 1.0. So this means not only are losses reported to date 100% developed or at their ultimate level, but so are paid losses. In other words, there's no case reserves set on this. It's 100. It's all paid loss, and we consider the accident year 2017 as of 12/31/2021 to be fully paid at $1,547, which is why there is no indicated IBNR here. So the last method we're going to talk about is the Bornhuetter-Ferguson method. And this method, basically, the underlying assumption here is that your IBNR is best estimated using an a priori assumption. And what makes this method different than our expected loss ratio method is that in this approach, we specifically state that it's only the IBNR for which you need an a priori assumption for. And in other words, the expected loss ratio method does not consider losses reported to date for the subject year to be informal to future, what the losses will ultimately pay out to. I know conceptually this is a very difficult method to kind of understand, but we're going to walk through an example that hopefully will add some clarity to it. And so that's exactly what this is doing. So this is walking the calculation of the Bornhuetter-Ferguson method. And you'll see that your columns 2 through 4 here are exactly the same as what was shown in your expected loss ratio method. And we're using the same data for all 4 of these loss development methods. And really, the Bornhuetter-Ferguson uses that expected ultimate loss via the expected loss ratio method as an a priori assumption for only the IBNR portion of your ultimate loss. So what needs to be done is we calculate our expected ultimate loss via the expected loss ratio method, and that's what's shown in column 4. But then we need to apply a factor to it to kind of pull out just the portion that we consider to be the IBNR. And in order to do that, we utilize our cumulative loss development factors that we calculated in our incurred loss development method. And we take 1 over those numbers in order to estimate the percent of ultimate that is reported as of 12/31/2021. So like we've kind of harped on for both the paid and the reported incurred development methods, accident year 2017 we consider to be fully mature, and therefore 100% of this accident year has been reported as of 12/31/2017, which is what you're seeing in column 6. But for accident year 2021, we know that that accident year is only 12 months mature, and therefore kind of using this methodology of 1 over our cumulative reported LDF there of 2.294, we say that 44% of accident year 2021 has been reported as of 12/31/21, and therefore 56% of it is considered to be unreported. So we take that 56%, multiply it by our a priori estimated ultimate loss, which again is from our expected loss ratio method and shown in column 4, and we multiply that 0.56 times our 2,275 value for accident year 2021 to get our indicated IBNR of 1,283 under the BF method for accident year 2021. We then add back our incurred loss, and we get an estimated ultimate loss as of 12/31/2021 under the BF method. So the BF method, like every other method, has its pros and its cons. The first con is kind of what we have talked about a little bit in both the expected loss ratio method as well as the BF method, in that we have to establish an expected loss ratio for that a priori assumption. And if we select poorly on that expected loss ratio and the a priori assumption of estimated ultimate loss is wrong, then our BF is going to be wrong. And so really needing to select an a priori assumption can pose some difficulties. The BF is also considered to be less responsive if that a priori assumption is not adjusted as new data comes in, right? So as new things are learned, if that a priori assumption of estimated ultimate loss that we use for calculating IBNR doesn't change and it just continues to be wrong, it's not responsive, it's going to be inaccurate. However, there is one huge benefit to the BF method that, and really the reason why so many actuaries rely on it, especially at early stages of maturity for accident years, is that it's considered to be more stable than the incurred development methods, especially, again, at early maturities. As you saw in the development methods, those factors for accident year 2021, for example, can be pretty large. And so we say actuaries call those factors highly leveraged at those early maturities, in that if an accident year, say, comes in a little bit higher as of 12 months and we have those large factors, we could be way overestimating ultimate loss using the incurred development method or the paid development method. Or if, an accident year comes in a little bit lower at 12 months mature than what historically we've seen, we could be way underestimating our estimated ultimates. So kind of balancing those, that issue with an a priori assumption is one of the major benefits that the BF imparts. So lastly, we're going to kind of aggregate all of our methods together in columns 2 through 6 that you see there. And again, all of these methods utilize the same underlying data, and therefore they're going to produce their estimates using the same underlying loss and premium data, but they're going to produce different numbers because they're different methods of calculating this estimated ultimate. Then the actuary's responsibility is to look at each one of these estimates and having a solid understanding of what the underlying risk is, and a solid understanding of what the pros and cons of each one of these methods are, make an assessment as to what they think, in a selection really, of what they think estimated ultimate losses should be. In this example, you see in columns 7 through 9, it's being selected at various levels of confidence. And so and really this is kind of an illustrative purpose, because what has been done here is that on the low end, it's just the lowest estimate that was selected. The estimate producing the lowest estimated ultimate was selected on the low end, and the method producing the highest estimated ultimate was selected on the high end. And then the central estimate is just taking an average of those two factors. More likely, what would be the case is that, again, the actuary would weigh the pros and cons of these methods. They would have an understanding of the underlying risk, and they would make a selection. I might give an example of the BF again. It is a more stable method at early development periods. So I might go and select the BF for accident year 2021 for the central estimate of 2358 based on its stability relative to the incurred development methods at early stages of maturity. Then this is just a quick table showing the calculations, some arithmetic to get you to your indicated IBNR. So what's shown in column 4 there is a selected ultimate loss from your central estimate, or your central selected ultimate. And then you simply just subtract the incurred losses from your selected ultimate to get your IBNR. And you add in your case reserves to get your total reserves. And that in column 7 is what would show up on your statement of actuarial opinion that Brittany spoke about earlier on in the presentation, and would also show up in your annual statement. So finally, in conclusion, I know we touched on a lot of information here. Just to recap quickly, Brittany talked about current issues in loss reserving, how the underwriting cycle impacts an actuary performing a loss reserving analysis, or how the market cycles impact the loss reserving cycle or analyses. She then talked about the actuary's role in reserving, including the production of an SAO and the various bodies that govern actuaries producing these reports. Then I walked through the reserving process. I walked through key terminology that's needed to understand the reserving process, as well as put that key terminology into action via looking at some claims going through their life cycle. And then finally, we actually got into the meat of the presentation, walked through some ultimate loss estimates and how actuaries estimate ultimate losses and how that impacts your income statement.
The Institute's Griffith Foundation, IRF, and the Cady School of Insurance at Illinois State University thank Brittany Henrik, Associate Actuary, and Patrick Newell, Consulting Actuary, both of Pinnacle Actuarial Resources, for sharing their insights and expertise. To learn more about forthcoming Griffith Foundation programming, please visit www.griffithfoundation.org.